Hello, folks. Welcome to the Weekend Investing Daily Byte of the 18th of September 2024. I am Parikshit, filling in for Alok today, who has a little bit of a network issue. So, markets today, of course, Nifty 50 has been oscillating within a very narrow band of 150 to 200 points. And in fact, if you notice the last three, four sessions, small caps, mid caps, the lower market cap segments have been witnessing a little bit of a profit booking, but a very peculiar aspect to note, especially from today's trend, is that banking stocks have done exceptionally well. Banking stocks have ensured that good performances from banking stocks have ensured that Nifty stays afloat. And today sectoral performances, if you see Nifty Bank, is up. The Nifty PSU banks, private banks, also the financial services index. Apart from these four sectoral indices, rest of the sectors are all down today. So banks kind of holding the markets up today. And of course, the big news, the market today, we are sitting on the cusp of the FOMC meeting discussion. We'll discuss that more towards the end of this, the second part of this session. But there's been expectation that there will be a cut, of course, but whether it's going to be a 25 basis point cut or a 50 basis point cut, whether there will be an aggressive cut, and what are going to be the future projections in terms of rate cuts is something that market participants will be very keenly observing from the meeting. So before that, of course, please read through the disclaimer. And in today's episode, we are going to do a very data-packed study on what to expect post the rate cuts. Yesterday, we saw what happened to the markets during the rate cut when the rate cut started, and also from the top of the rate cut, and also the bottom. We observed that yesterday, the performances of gold and INR, Nifty, and also S&P 500. So today, what we'll do is we will take a look at the past 1 year, 2 year, 3 year, 4 year CAGR before the rate cut was announced, at the cusp of the rate cut, and also the forward performance is what we are going to focus on today. So forward 1 year, 2 year, 3 year, and 4 year CAGR of S&P 500, which is the mother market, and also Nifty and gold. That is what we are going to see across the three rate cut cycles that are in discussion. So that is going to happen at a later stage, but please do subscribe. We get a lot of motivation if you subscribe, and also we get a lot of we are very happy to see all your comments, and also do click on the bell notification. Where is the market headed? Of course, Nifty, if you see the narrow band that I was just talking about, minus 0.16% today, absolutely flat over the last few sessions, no progress in Nifty. But this big candle that we observed last Thursday, that seems to be the top of that candle, seems to be the resistance for the markets. Of course, if based on the narratives, from today's FOMC discussion, maybe there will be fresh moves that could take place in the markets. Nifty next 50 has been finding some resistance around this mark. There has been a lot of choppiness around this zone at 74,900 for Nifty Junior, and that is what we are able to see now as well. Two times, it tried to break away from this mark, but once again came down. Higher lows being consistently made here, which is a positive sign. But there was a breakout and retest, breakdown, and once again took support at 40 DMA, 40 day simple moving average, and has been chopping around the same mark. Lost about 0.5% almost today. But mid caps, of course, losing slightly more than the larger market caps at about 0.7%. Mid caps, after finding some resistance here, broke away from this resistance, made a new high, and once again have retested this mark here, took support, and have bounced quite okay, I would say, today, currently at about 22,080 levels. Small caps also relatively better looking chart than the mid caps, but three consecutive red candles of profit booking sessions observed on small caps at about minus 0.34% today. And if you look at Bank Nifty, exceptional performance, 1.08% up. In fact, Bank Nifty, after momentarily breaking away from this resistance, once again came back within this zone. Will find some sellers sitting around this mark as well. So there will be some test around this level for Bank Nifty in the future too, if momentum doesn't sustain. So momentum trends, of course, of advances and decline trends, we have 276 stocks, more than 50% of the stocks between 0 and 2% loss today. 70 stocks between 2 and 5% losses, compared to 103 stocks at about 0 to 2% mark. So clearly a bearish day. Not a lot of segments moving up today. Very, very few pockets of the markets doing well. Banking stocks are one of those, but we will take a look at that later. FIDI trends, of course, FIs started on a buying spree from 9th of September till 13th of September. We can see a lot of buying from FIs. DIs have been quite consistent, except for these two days where there were outflows. Rest of the sessions were all okay for DIs, but FI saw some selling, but we'll see clearer trends emerge post the FOMC outcome. So today's heat maps, of course, banking pockets very, very strongly holding up. A lot of choppiness, a lot of profit booking in the IT segment. Infosys losing 3%, TCS also losing around the same level, TCS and HCL Tech. So IT stocks dragging the market, whereas the banking stocks were trying to hold the market up. So predominantly Nifty has been almost in the quarter percent loss territory today, majorly because of the heavyweights not doing well from the IT segments, and even rest of the pockets also not supporting quite well. So banking stocks all good. SDFC Bank, ICICI Bank, Bajaj Finance all doing quite well. So if you do look at the Nifty Next 50 universe, very, very few stocks doing well. Motherson, Sumi, T-Mart, Zomato going up 1.8%. Motherson at 4.69%. PFC, Bajaj Holdings all doing okayish. Again, the banking stocks are quite good, and rest of the segments are not so good today. Sectoral trends, Bank Nifty, banking segment, as I discussed before, Bank Nifty index, private banks, PSU banks, and also the financial services index doing really well. Financial services, in fact, we have not included that in the current chart, but we will see that in the sectoral representation data. So if you see IT lost about 3%, but rest of the market, pharma also saw some profit booking. Pharma has been very, very strong, exceptionally positive momentum in pharma in the recent times, but today there's been some profit booking here as well. On a weekly basis, also things are looking quite fine. And the leaders of the last 12 months, real estate and PSCs are seeing some loss in momentum. Going on to the sectoral spotlight, we have financial services index. Of course, as I discussed, 1.4% gains, breaking above this resistance and doing very well. Very, very strong candle, supported by Sriram Finance, Bajaj Twins, also doing well. Power Finance, ICICI Lombard, ICICI Bank, all doing exceptionally well, contributing to the performance. Solid performance across, for this sector. Stock spotlight again, BSC, tremendous rally here. So that is what we keep talking about, right? So when there is momentum, the stock will run up like it is nobody's business, like it is, caught some fire or something. So that's what we are seeing. 18% up 2 days ago, and today we are seeing yet another 16.8% rally. Phenomenal rally. And in fact, in the last couple of months, from 2000 levels, it's gone almost to 4000 odd levels. So 80-90% sort of a performance across 2 months is exceptional. Great momentum in BSE as well. So coming to the story, what to expect post the rate cuts is what we will discuss today. It is going to be an analytical perspective on what has happened before the rate cuts, how the markets have run up, and after the rate cuts, whether markets have been sluggish, how long has it taken for the markets to recover, is what we will try to derive out of this. And very quickly, I think it's going to be either whether it is going to be a gradual 25 basis point reduction, or it's going to be an aggressive 50 basis point reduction, is what a lot of enthusiasts are debating about. And of course, there's going to be projections on the rate cuts in the future as well. So all of that very, very important day tonight, event tonight, as far as the cycles are also concerned. Newer leaders could emerge out of this entire shift in regime. So we'll have to wait and watch how things shape up, but we'll discuss that towards the end as well. So let's analyze S&P 500, Nifty, and gold past 1 to 4 year CAGR and forward 1 to 4 year CAGR. We will not keep the focus on the past performance. Of course, you can pause the video at any point in time to observe the performance, but we'll keep the focus towards what to expect. So the future performance after the rate cut is announced. So we are sitting over here now. What happened 1, 2, 3 year and 4 year CAGR before this rate cut started, the peak, and what happened 1, 2, 3 and 4 year CAGR after this rate cut was announced. That is what we're going to discuss. And we have taken the same three phases that we took yesterday, and let's discuss the phase A, starting with this phase. So 6.4 to 1% is what the rates went down to, and starting from Jan 2001. The past performances, I will not spend too much time on this. You can pause the video and take a look at this. Of course, the past performances during this phase was not so good as the next few phases that you will take a look at. S&P 500 at about 14%, 15% CAGR across the last 4 years, till the time the rate cuts were announced. Nifty underperforming, and gold also very much flattish during the entire phase. So now going to the forward performance, S&P 500, of course, a good trend that will be very important for you to observe from this analysis is that if you look at the first year, there has been choppiness, there has been some correction in the market for sure. So S&P 500 losing 13%, and 2-year CAGR is 18.3% loss. 3-year CAGR gradually recovered to 5.6%, minus 5.6% and minus 2.1%. So the 4-year CAGR after the rate cut, the first rate cut was announced in 2001 Jan, has been completely negative for S&P 500. And this might be shocking. This might be new information for a lot of people, but that has been the outcome. But Nifty has been considerably better. There has been some choppiness right at the start for Nifty, 16% loss in the first year. 2-year CAGR gradually recovered to about minus 7%, but on a 3-year basis, fantastic recovery at 14.2% CAGR, and 4-year CAGR very, very reasonably solid at 13.3%. So gold, what has gold done in the forward 3 years and 4 years performance at 14.4% 3-year CAGR and 10.7% 4-year CAGR, doing really well, of course, for sure, no questions on that. So, but quite consistent performance for gold is what we can observe. Phase B, 5.2% to 0.1% starting from July 2007. Of course, the past performances were exceptional during this phase. The past 1-year CAGR, 2-year, 3 years, and 4 years, simply superb. S&P 500, nothing major, but better than their long-term average at about 8-9%. Now, a 4-year CAGR of 11.5%. But look at Nifty, tremendous. Just imagine a 40% CAGR for 4 years. If that is what Nifty 50 could achieve in 4 years, just imagine the kind of performance that one would have been able to see in the lower market cap segment. So some of the stocks within Nifty also exploded completely. A phenomenal bull rally is what we got to see during this period, and great performance. And even gold also was really strong, except for this minor blip 1-year basis. I think the 4-year CAGR also at 13.2 is always something that anybody could take. Just from the perspective of someone who's holding this as a hedge to their equity. So great performance, no questions on that. Forward performance, let's take a look at that now. So S&P 500 at about, again, all four performances, I mean, 1-year to 4-year CAGR, all in the negative territory. But Nifty, similar pattern. The first year is down and gradually recovered well. 3-year CAGR at 7%, but 4-year CAGR also at 7%. So this is the period when Nifty saw a flattish performance for 6 years from 2008 all the way till 2014. So, but what did gold do? Just look at this. Exceptional turnaround for gold. 1 year at 51%, 2-year at 30%, again 30% and 26%. So 4 years if you held gold during this time period, the 4 years after the rate cut was announced in 2007, exceptional performance. Your portfolio, even a small allocation to gold, would have offered a lot of peace to your overall portfolio. During this time of during this volatile period in the market. So phase C, again, the latest phase that we have for data is between from August 2019, when the rate cuts witnessed a drop from 2.4% to 0.05%. And let's see what happened in the 4 years before that. Good performance, of course, in S&P 500, beating Nifty during this phase. Nifty was sluggish during this entire phase between 2015 and 2019. Nothing much happening. Overall, there was, I think, an absolute return of 30% in Nifty. But gold also sort of doing well initially, but dropping off in performance during the later stage. And 4-year CAGR at about 8.7 is not bad. I mean, beating Nifty is the most important thing, that almost in line with S&P 500 and beating Nifty. That is the most important takeaway from this chart. So forward performance, if you see, of course, post-COVID rally was taking over. The first year was flattish for Nifty, but gradually it gained momentum, did really well. Gold, saw a correction. The first year lost some momentum, and then further picked up during the later part. Right now, coming to the conclusion here, setting the right expectation. So we'll quickly take a look at the consolidated numbers for S&P 500. So on an average basis, S&P 500 has lost the first, across 4 years after the rate cut started. 4-year CAGR, I mean, the averages have been between minus 2%, minus 6% and plus 2% mark. But the last phase was considerably better. Here you can see negatives all around the corner, but the latest rate cut phase, S&P 500 did quite decent. But still, the averages are much lower than Nifty, what you're going to see here. Nifty, of course, has been averaging between minus 7.5% CAGR to almost about 12%. Reasonable performance, better than S&P 500. But of course, if you look at the USD terms, maybe this could be slightly lower, but we are just looking at pure absolute performance here. Gold, if you see, has done exceptionally well. In fact, the averages are much better, from the rate cut perspective. So any allocation to gold would have resulted in a very solid sort of a hedge for your equity portfolio and would have ensured that you remain peaceful at all points in time. So, final thoughts. S&P 500 historically has not done well every time the rate cut cycle began. The last cycle was much better than the previous two cycles. But Nifty has witnessed negative performance right at the start, but over a period of time, gradually the recovery has been very quick on Nifty. And the 4-year CAGR has been quite good. And if I just have to quickly go here, if you see the 4-year CAGR has been at 13.3, 7.2, and 15.7. So the recovery has been quite comfortable with Nifty. But gold has been extremely steady across all cycles. If you see gold, 5.8%, 20.3, and 19.0, and 16.8. Phenomenal performance for gold, and that is a cue that perhaps one can consider having exposure to gold, especially when the cycle starts. So that will always provide some cushion to your overall portfolio. So what are your expectations from the markets going forward? Is what I want to we would like to observe from your perspective. Please do mention in the comments what are you expecting from the markets, and our team will be very delighted to see all the comments. Alok personally goes through all the comments and tries to reply to most of those comments. And thank you so much. I'll see you in another video soon. Bye bye. So please do subscribe to the channel, like this video, share this video to all your friends and family who you think can benefit from this video, and also mention your inputs in terms of how you liked this episode. So thank you so much. I will see you in another video soon. Bye bye.